blog, 8th of January 2012. First blog of 2012. It'll be an interesting year, I imagine. So we'll get right to it. This time I'm gonna do something different. I'm gonna start out by looking at the monthly chart of the New York Composite Index for the last 15 years. So that's since 1997. So here we had the dot-com bubble and the 2000, 2001, 2, and 3 recession, or jobless recovery as they like to call it back then. Then we had this massive run up into the real estate bubble, and then the real estate collapse. Real estate hit a high in 2005. The market ran a lot further after that, simply because people took out lots of cash on their private ATMs, their house, and continued to spend it, and all of these things always take a lot longer to resolve themselves. But when they do, the US investing public being of bipolar nature, things are either really good or really awful. There's nothing in between. So we have this run up here, straight run up, and then straight down. So until this point up here, nobody noticed that there was something wrong. Then everybody noticed that there was something wrong. And then once again, nobody noticed this run up because everybody was still stuck in oh my god mode. And we had this run up over the last 2 years, and now we've had a drop right here. And the big question on everybody's mind is, how is this going to continue? There's some positives definitely working in the world's favor. Part of that is obviously the massive amount of consumers that have joined in the consumption on the planet, i.e. India, China, Indonesia, Brazil, many developing countries who now want cars and fridges and all the other things, and that consumes resources, and that is good for manufacturers. So what are we going to look like in 2012, and are we going to go further down, or are we going to go further up? That's a good question. And for that, I'd like to go over to the weekly and the daily chart, but for the time being, I'd just like to point out that we did have a double bottom here in 2003 and 2009. That is a double bottom, and this rise and this rise here have been very much liquidity driven. Are we going to have more liquidity coming out of here? I imagine we will, simply because governments are basically broken. The only thing they can do is to create money out of thin air that drives inflation, and inflation drives stock markets. Inflation, of course, is good for businesses in the beginning because it drives the consumers to buy more and spend more. Going over to the weekly chart, so this is since 2009, the bottom, and relatively steep start. The 1030 exponential moving average, one of my favorite indicators, has been indicating mostly bullish, and it has been indicating bearish here for the last year, let's say. Half a year, since August, it has been indicating bearish on the weeklies. And if we go over to the dailies, again, same chart on a daily. The 10 has once again broken out above the 30, and the individual days are staying above the 10. So that's rather bullish right here. Is this going to hold? Nobody knows for sure, but right now momentum seems to be in favor of the bulls. Of course, here we have a little bit on the OBV. We have a bit of a downtrend, and this particular chart in general, we have been putting in lower highs. So we have a lower high here, there, there, and there. And that sort of indicates we're still below the 200-day moving average. And it could very well be that we're going to turn down even further here. I was just listening to some analysts, and they indicated that what happens in Europe will definitely determine how this will play out. If European banks are going to be in deep trouble, and I do believe they will be, they will have to raise capital, and the only way to raise capital is to sell stuff, and you can only sell stuff that actually has a market. So they will be selling stuff, and they will be selling the good stuff, because nobody wants to have the bad stuff. That could very well drive markets down, and it could continue to sustain um, the the euro and the US dollar as currencies. Now, I wouldn't be betting too much about on the euro, but the US dollar will take advantage of this, because while people will be selling things, people basically escape into cash. It's the only safe place to be that has the amount of liquidity to absorb all of this money. So while European bankers will be selling their assets and markets drop, people will be escaping into the major currency, which is still the US dollar as of this point. It's not a good currency, but it's the best in the bunch. So we could very well, until this plays out completely, if there is a crisis in the spring in Europe, and there's a good chance there will be, we could be looking at another market downturn. I have heard numbers like 20% thrown around, and the latest I heard is that the lows could be in April. Now, the particular analyst I was listening to was very bullish on the world after that. I do agree, companies have lots of money, they got lots of cash, they're flush with cash. Governments are broken, but businesses are doing extremely well. So going back to this chart, if we are looking for a downturn here by another 20%, it could land us somewhere in this general area here. If that does happen, and it were to happen in April, then after that, we could very well be looking for another bull market, simply because companies are actually doing quite well. And perhaps along with that, consumers will recover as well. But the fact that there's so many consumers in developing countries can simply drive demand, because people want cars and fridges, and they don't really care if there's a recession on. They don't want to put their life on hold. So that's what I'm looking at right now. Now let's look at individual charts here. Here we have the US dollar, very strong right now. I have quite a bit of US dollar in cash right now, and that's going for a nice little run. It's funny because everyone wrote the US dollar off right at this point here, and that's usually the time you want to buy. So the US dollar has been very much in a bull market, and anything that is traded in US dollars, like oil, of course, then has been going down. Now, oil has stayed very stable because there's fears over Iran. But if those fears start wearing off, and perhaps we don't go to war with Iran, then oil could very well drop. Here's the 10-year chart for oil, and there's a long-term trend line right here for the 10-year. A trend in oil. Oil can easily drop down to 60 eventually, perhaps in April, maybe, on lower demand and a higher US dollar, and then still be in a bull market that is driven more by actual usage patterns and inflation rather than a liquidity and bailout funds trying for a safe place to invest. So oil, basically a lot of things are going to be suspect. If there's actually a drop in the market, it doesn't matter it's a good asset, it doesn't matter whether it's a bad asset, everybody wants to be in cash when the market drops. Natural gas has been dropping a lot just because we have so much of it. That's a North American issue. The rest of the world is short natural gas, and we could be short one day again, but I was hoping there would be a turnaround in the price of natural gas, but it didn't happen. Gasoline, on the other hand, is seeing a bit of a pickup here. This is once again reflecting a possible turnaround in the economy, and that could turn down again if the market drops until April, but then it could easily once again pick up. Gold, I'm always a lover of gold. I like the physical metal myself. I like to have it around. I like the feel of it. But it too could suffer a drop simply because when things need to be sold, then anything is going to be sold, and it doesn't matter how good your resource is, it will be sold because people need to buy buy back basically their debts. I mean, they need to pay off their debts. Silver, similar thing, more of an industrial metal. Copper has also not been looking too bright. That tells us something about China. Construction is definitely in trouble in China, and there might be some unknowns coming out of China. So copper is not as high as it was before. General resources again have been dropping along with the US dollar going up. And one of my personal gambles is interest rates, I believe, are way too low. They should be higher considering the risk that people who buy bonds are taking. And this very much here starting to look like a bottoming action. So this is the 10-year bond, 10-year US Treasury bond. And we had a low in September, October of 172. This is the yield, by the way, the 10-year yield, 1.72, 1.82, and now we're up at 2. It almost looks like this could be a bottom. Now we might look at another dip here if the market actually does go down until April, but then after that interest rates must recover, because what's the point of buying, lending money to any government, doesn't matter which one, lending money to any government and getting nothing in return. That just seems very, very silly. So eventually interest rates will go up, and they will go up as soon as money has another place to go rather than just cash. The VIX fear indicator seems to be way down. Fear is once again out of favor. This should rise possibly until April and then drop off again, and then we'll have to evaluate what comes after that. So I think there is a pretty good chance. I do agree with this analyst by the name of Ben Simon out of Singapore. Very very intelligent man, that there could be a bit of a downturn here in the spring, and then perhaps we are looking at a pretty long-term recovery after that. See what happens, but that's my take for where I think the market might just go. Anyways, that's all I have for today. Good luck, make lots of money, and see you sometime.